Hi, I'm Garrick Schmidt, Marquette's Director of Private Equity. Welcome to Marquette Associates' Alternative 101 series on private equity. In this presentation, I will be covering a basic overview of private equity, including what is private equity? How is the private equity market segmented? What are the advantages and risks within private equity? How is private equity investment performance measured? What is the structure and life cycle of a private equity fund? What is the standard terms and fees of a private equity fund? And finally, what are the critical considerations when starting a private equity program? So what is a private equity investment? A private equity investment is an investment in the equity ownership of a private business. From an institutional perspective, investing in private equity typically requires a commitment to a private equity fund, which will then go on to make a number of investments into private businesses that are believed to be undervalued and where a manager believes their operational and sector expertise and capital can help grow that business. We're in the midst of a profound shift within the market as institutional investors look to increase their private equity exposures. Institutional investors such as pension funds, sovereign wealth funds, endowments, foundations, and insurance companies are all pouring money into private equity in hopes of achieving higher returns within this inefficient asset class. The private equity market provides investors access to a considerably larger universe of potential investments. For instance, based on the 2015 census, there are nearly 6 million businesses in the US, but US investors only have access to just over 4,000 of these businesses through public markets. The private market makes up the rest of the market, with private equity investors owning just 8,000 of those businesses, or just over 1% of the private businesses in the US with over 20 employees. We believe continued institutional demand will lead to an increasing penetration of the number of private equity-owned businesses in the market, as investors look to increase their investment exposure within this large and inefficient area of the market. As the private equity industry has doubled in size over the last decade, now with nearly $3 trillion in assets under management, we have seen increasing segmentation within the market. Subsegments of the private equity market, as highlighted here in the table, allow for more narrowly defined risk and reward characteristics. The 5 distinct subsegments of private equity remain venture capital, growth equity, buyouts, private debt, and distressed investments. You can see the different and very general return characteristics, financing, duration, risk, investment stage, and likelihood of success, along with ownership stakes within the table here. The largest portion of the private equity market remains the buyout market, with an investment focus on controlling a business through a leveraged buyout. There are generally 3 distinct segments of this market. There's the small buyout market, the lower middle market buyout market, and the middle market buyout. We are starting to see a growing market for large private buyouts, mostly in the form of public companies that are taken private, but this remains a focus of just a small number of very large funds in the market. Funds focused within the small buyout market look to make investments in generally regionally focused businesses, typically with less than $10 million of EBITDA, that are often founder or family-owned businesses with significant opportunities to professionalize the business through operational improvements and an infusion of capital to grow the business both organically and through acquisition. Funds focused on the lower middle market buyout space look to make investments in generally larger businesses, typically with 10 to 50 million of EBITDA. These can be founder or family-owned or even institutionally owned by other private equity firms, with opportunities to continue to professionalize the business and management team with capital really focused on growing the business. At the larger end, funds focused within the middle to upper end of the buyout market look to make investments in larger, nationally focused businesses, generally with 50 million or more in EBITDA. These businesses generally are institutionally owned or public businesses with the opportunity to expand geographically or even internationally, with capital focused on really growing these businesses. The second largest area of private equity remains the venture capital space, with investments in the form of minority equity ownership in less mature but rapidly growing businesses. The earliest stage of capital is seed investing or angel investing. These are minority equity investments that are typically provided to entrepreneurs when launching a business and are typically pre-revenue. The largest and most traditional institutional venture capital allocations are within the early stage space. These are minority equity investments that are typically provided to entrepreneurs to expand a proven concept within these businesses. And these businesses are typically already generating revenue, but still remain unprofitable. The most rapidly expanding area of the private equity market remains the late stage or growth equity space. These are often minority equity investments in businesses that are either owned by entrepreneurs or institutions with proven concepts generating substantial amount of revenues and potentially profits. This capital infusion is often used to continue to grow the business with the likelihood of a near-term exit, either through taking the company public through an IPO or through a strategic acquisition by another company. The primary institutional attraction to private equity remains the opportunity to access an asset class that has consistently delivered higher returns relative to other asset classes over a very long period of time. The key advantages that have helped private equity perform so well over the past decades has been the ability to have ownership control of a business, the investment leverage utilized within these transactions, a strong alignment of interest between management of a business and the equity owners, and finally the due diligence and price discovery that occurs when investing in a private business. With the strong advantages within private equity also come considerable risks, including the higher investment risk that comes with owning the equity of a small business, the weaker fund and regulatory oversight of these investments, the illiquid nature of private equity, the higher fees within private equity, and the subjective performance and valuation reporting. And finally, considerably higher manager selection risks in this area of the market. Something most new investors struggle with is the performance measurement aspect of private equity. These measurements are often very different from traditional public investments, given the closed-end nature and the investment structure of a private equity fund. Private equity investments are typically evaluated using three non-traditional measurements. The first, IRR. This is a percentage that gives investors the annualized effective return and is a good indication of capital efficiency. TVPI, which is a multiple that provides investors a cash-on-cash return or total return on their investment, which is unaffected by the timing of those cash flows. And finally, a PME IRR. This provides investors a relative value comparison, matching an investment's cash flows and distributions to generate a return that would have been generated if those cash flows had been invested in the public market. Private equity investors should consider all three metrics and be patient with their investments. We caution early metrics are not a strong indication of likely fund performance until at least year 4 of an investment, as it takes time to deploy the capital and begin to see operational improvements within these businesses. Another issue very different from a public equity investment is the legal structure of a closed-end private equity fund. Private equity funds are organized as a limited partnership, with the private equity firm acting as the general partner and investors as the limited partners. The fund then invests in underlying businesses with this structure limiting the ultimate liability for investors to their commitment into the fund. A private equity fund's life cycle is typically 11 to 15 years for investors to get their last dollar back following a private equity commitment. The general life cycle of a fund is typically 0 to 12 months to fundraise, followed by 4 to 5 years to make 8 to 15 investments, followed by 5 to 6 years after each investment is made to grow and then sell the business. However, it is common for a couple of these investments to require a little additional time before it is suitable to sell. So funds allow for a couple of years of extensions to the fund's actual life cycle. As we look at the likely expected cash flows from a private equity fund commitment, we can see that there is usually significant outflows in the early years as investments are made and fees are generated. Investors typically pay management fees on their full fund commitment, while private equity managers seek opportunities to invest this capital. These management fees and slower deployment of capital typically generate a negative return during the early years of a fund. However, performance generally improves as capital is fully deployed and operational improvements occur within these businesses. And with investment exits occurring in the later years of a fund, this negative early and positive later performance returns provide what is known in private equity as the J-curve. As a sample, typical investor fees and fund terms are highlighted here. It is standard for private equity funds to charge a 2% management fee on committed capital, perhaps down to 1.5% for larger funds, with a 20% performance fee if their funds provide investors with an annualized rate of return that is greater than their hurdle rate, which is commonly 7 to 8%. The typical fund charges fees for 10 to 12 years, with management fees often charged on the full commitment during the investment period before dropping down to fees on invested capital or NAV in the remaining years of the fund. The funds raised within a calendar year are typically referred to as a vintage. As investors become more experienced and their programs mature, they often begin to realize that vintage year or the annual year of their commitment can matter a lot. Some investors attempt to then time their private equity commitments. But we would caution it is very difficult to time the market, and even harder to time the market on a future 5-year rolling basis. In this graph, we highlight the 25th and 75th performance dispersion of funds raised within each calendar year. As we can see, there is considerable performance dispersion of funds raised within any given vintage. Within this range, we can see performance can vary widely from the mid-single digits all the way to the low 20s on an annual basis, highlighting the importance of manager selection within this asset class. We believe investors should spend less of their time attempting to time the market and more of their time focused on consistently allocating capital in a disciplined manner annually to the highest quality managers they can find. So what are the key takeaways? We don't want investors to be scared as they enter private equity. First, private equity is a growing area of the market that investors should continue to seek out as they look to increase their portfolio returns by taking advantage of their portfolio's ability to handle illiquid investments. Next, there are a lot of different areas of the private equity market. These different subsegments allow investors to construct programs that meet their risk-return objectives. Additionally, we believe inefficiencies and competitive advantages within private equity are very sustainable, but caution, it is important to understand and accept the risks of private equity investments. We caution investor patience is required. These investments take time, both from a performance perspective as well as a liquidity perspective. And finally, investors should think of this as not making an individual investment, but should be focused on building out a private equity program. Take the time to think through how you want to build your program. Be consistent with your annual deployment and spend time focusing on finding the highest quality managers in the market. Hopefully you found this brief introduction helpful. We thank you for watching.